A weekend that should have been quiet has turned into a financial crime scene. It is Sunday, February 1st, 2026. In the last 72 hours, $15 trillion has been wiped off the face of the earth. Gold down 15%, silver crashed 31%, and now the contagion has spread to crypto. Bitcoin, Ethereum, Solana, bleeding out another $500 billion as we speak. This is the first Sigma 10 event in financial history. Mathematically, this shouldn't happen in the lifetime of the universe, yet here we are. I need you to turn off the football game, close Netflix, and stop looking at your red portfolio for a second. Because while $15 trillion vanished from your screens, it didn't just disappear. It went somewhere. Someone took it. If you are watching this, you are witnessing the system breaking in real time. Where are you seeing this from? Are you in shock in New York, or are you buying the dip in London? Let me know in the comments. Let's be very clear about what just happened this weekend. This wasn't a market correction. This was a forced liquidation event executed in a vacuum. Over the last 48 hours, the crypto market alone saw $2.5 billion in leverage wiped out. This marks the 10th largest liquidation event in the history of digital assets. 335,000 traders were carried out on stretchers. But looking at the raw numbers doesn't tell you the real story. You have to look at where the liquidity vanished. Bitcoin didn't just fall, it fell into an air pocket. When price action drops through key support levels with zero buy orders to catch it, that is not natural selling pressure. That is a liquidity hole. We saw 3 distinct liquidation waves totaling $1.3 billion in just 12 hours. This is what happens when the exit doors are too small for the crowd trying to leave. And here is the specific number that terrified the institutional algorithms this weekend: 74,600. That is the approximate break-even line for MicroStrategy's massive Bitcoin treasury. Michael Saylor's strategy currently holds over 673,000 Bitcoin, acquired at an average price of roughly $75,000. When Bitcoin dipped below 76,000 in the early hours of Sunday morning, the entire market held its breath. Why? Because if MicroStrategy goes underwater, the psychological floor of this market disintegrates. The algorithms know this, the hedge funds know this, and they hunted that level aggressively. They pushed the price to within 1.8% of that red line, trying to trigger a cascade that would force the largest holder in the world to blink. This wasn't just volatility. It was a stress test of the entire crypto leverage structure. But you cannot understand this crypto crash if you don't connect it to what happened on Friday. They are not separate events. They are the same shockwave traveling through different asset classes. The trigger was the failure of Metropolitan Capital Bank and Trust, the first U.S. bank failure of 2026. Assets, $261 million. Deposits, $212 million. You might say, John, that's a small bank. Why does it matter? It matters because in a fragile system, the first domino doesn't need to be big, it just needs to fall. When Metropolitan failed on Friday, it sent a signal of systemic liquidity tightness. Banks stopped lending to each other. Hedge funds saw their credit lines tighten. And when you need cash immediately to cover margin calls, you don't sell your real estate, you sell your most liquid assets. You sell gold, you sell silver. And on the weekend, when everything else is closed, you sell crypto. This explains the mechanical slaughter we saw in silver. And this brings us back to the smoking gun I mentioned earlier. The CME Group, the entity that controls the COMEX futures market, raised margin requirements on silver by nearly 47% right in the middle of the crash. Imagine you are playing a game of poker, and suddenly the house demands you put up 50% more chips just to keep your hand. If you don't have the cash, you fold. That is exactly what happened to the speculators. They were forced to fold. And who was sitting at the table, ready to take their chips? JP Morgan Securities. The data confirms they closed 633 short contracts exactly at the settlement price of $78. They didn't panic, they didn't sell, they bought. They used the margin hike, which flushed out the weak hands, as the perfect cover to exit their short positions at the absolute bottom. While the retail investor was receiving a margin call notification on their phone, the largest bank in the United States was quietly covering its shorts, effectively transferring wealth from the leveraged speculators to the institutional balance sheet. This was a transfer mechanism. The paper market was used to smash the price, creating a discount for the physical accumulation that is happening behind the scenes. We know this because while the paper price collapsed, the physical market in Shanghai refused to budge. The premium there is still sitting at 43%. Think about that. If this was a real sell-off, physical metal would be flooding the market. It isn't. It's disappearing. The disconnect between the paper price in New York and the physical price in Shanghai has never been this wide. The paper market is screaming sell, while the physical market is screaming shortage. So, we have a bank failure triggering a liquidity crunch. We have CME raising margins to force liquidations. We have crypto acting as the weekend ATM for distressed funds. And amidst the chaos, we have JP Morgan closing shorts at the lows. This is not a chaotic market. It is a highly ordered extraction of value. While the algorithms were busy draining $15 trillion from the global balance sheet, what was the mainstream media showing you? They were flooding the airwaves with the Epstein client list releases and terrifying headlines about World War III. Do not mistake this for a coincidence. In the world of systemic finance, there is no such thing as a coincidence. There is only timing. The oldest trick in the magician's handbook is distraction. Look at the left hand waving the bright red flag of scandal and war, so you do not see the right hand reaching into your pocket. While the public was arguing about names on a flight log and panicking over aircraft carriers, the real war, the financial war, was being fought and won in the dark pools and futures markets. Let's dissect the geopolitical narrative that was used to grease the skids for this crash. Just as the markets were closing on Friday, we received reports that Donald Trump had deployed troops and warships to the region, issuing a stark ultimatum to Iran regarding a deal with Israel. This is the classic fear premium injection. Simultaneously, Qatar's Prime Minister and Foreign Minister, Mohammed bin Abdul Rahman Al Thani, arrived in Tehran. He wasn't there for a friendly visit. Reports indicate he was carrying a final, perhaps non-negotiable message from the United States to Iran's supreme leader. When the market hears final message and sees carrier strike groups moving, the immediate reaction of the average investor is to buy gold. That is what the textbooks tell you. But the institutional reaction is the exact opposite. When real war threatens a leveraged system, the first rule of the hedge fund manager is, cash is king. You do not buy gold. You sell gold to raise the cash you need to survive the margin calls on your equities and bonds. This is exactly what we saw in the early days of 2008. This is exactly what we saw in March of 2020. In a liquidity crisis, you don't sell what you want to sell, you sell what you can sell. Gold, silver, and Bitcoin are liquid, so they get sold first. The war headlines didn't cause a flight to safety, they caused a flight to the dollar. Let's look at the historical precedent. Go back to 2008. Before Lehman Brothers collapsed, there were smaller failures. There were contained issues. The market ignored them until it couldn't. The failure of Metropolitan Capital Bank this Friday is hauntingly similar. It is a small crack in the dam. The establishment will tell you it is isolated. They will tell you the system is sound, but the bond market is screaming otherwise. The crash in metals and crypto is the market pricing in a systemic credit freeze. When banks stop trusting each other, when the repo market tightens, the grease that keeps the global financial engine running dries up. The gears grind to a halt. And when that happens, asset prices do not just drift lower, they elevate down. But here is the cynical truth that separates the tourists from the professionals. While the retail herd was panic selling their Bitcoin at $78,000 and their silver at $28 because they were terrified of World War III, the smart money was taking the other side of that trade. Do you really think JP Morgan didn't know about the bank failure before it hit the newswire? Do you think the insiders didn't know the tone of the message being sent to Tehran? They knew. And they used the geopolitical fear as a tool to execute the largest wealth transfer of the decade. They needed a catalyst to reset the board. They needed a reason for the price to crash that the public would accept. Oh, it's the war fear, the pundits say. Oh, it's the bank failure. No. It is a raid. $15 trillion does not just evaporate. It changes hands. It moves from the impatient to the patient, from the leveraged to the liquid, from the fearful to the ruthless. We are watching a replay of history, but at a speed that the human mind struggles to comprehend. In 2008, the unraveling took months. In 2026, with high-frequency trading and algorithmic execution, it happened in 72 hours. The geopolitical tension is real, yes. The risk of war is real, yes. But the market reaction was engineered. They used the fog of war to obscure the mechanics of the theft. Now, I want to take you away from the flashing red screens of your brokerage account. I want to pull you out of the simulation where numbers on a screen dictate your emotions and bring you down into the cold, hard dirt of the real world. The world where physics still applies. The world where supply chains break. The world where you cannot print an element on the periodic table. If you are looking at the spot price of silver at $78 and thinking the value of the metal has collapsed, you are falling for the oldest trick in the book. You are confusing the map with the territory. You are confusing the receipt for the dinner with the meal itself. Let's perform a forensic audit of the physical market, sector by sector, ounce by ounce. Because when you strip away the paper leverage, what remains is a supply deficit so terrifying that the industrial giants are starting to panic in private while the public panics in public. The arbitrage of the broken window. Let's look at Shanghai. While New York traders were panic selling paper contracts on Friday, the Shanghai Gold Exchange, the largest physical spot market in the world, was trading silver at $122. Do the math. That is a $44 difference per ounce. The premium in China is currently sitting at 43%. Now, any Econ 101 student will tell you about arbitrage. They will say, John, if silver is 78 in New York and 122 in Shanghai, why don't traders just buy COMEX bars, fly them to China, and pocket the risk-free $44? That is the multi-trillion-dollar question, and the answer reveals the rot in the system. They can't. Why? Because the silver trading at $78 on the COMEX does not exist in a format that you can move. It is a digital ghost. To turn that futures contract into a physical bar that you can load onto a cargo plane requires navigating a labyrinth of warrant juggling, loadout limits, and vault queues. We are hearing reports from authorized participants that the queue to load physical metal out of COMEX vaults has now extended to 16 weeks, 4 months. In a market crashing? That shouldn't happen. If the price is crashing, people should be selling, vaults should be accepting metal, not locking it down. The fact that the premium in Shanghai didn't collapse when New York crashed proves one thing. The East knows the West is out of metal. They are not following the COMEX price anymore. They are setting their own price based on physical scarcity. The arbitrage loop is broken because the inventory required to close it isn't there. 2. The solar vortex, the energy sink. Now, let's talk about where this metal is actually going. Let's talk about the industrial vacuum cleaner that is the photovoltaic industry. In 2024, the solar industry consumed roughly 190 million ounces. But here is what the mainstream analysts missed, and what the paper traders ignored. The technology changed. We shifted from PERC cells to TOPCon and HJT, heterojunction cells. Why does that matter? Because TOPCon cells use 50% more silver per watt than the old technology. HJT uses even more. In 2026, with the global green energy mandates kicking into overdrive to meet the 2030 targets, solar isn't just growing, it is devouring the market. We are projecting solar demand this year to hit 240 million ounces. That is nearly 30% of all the silver mined on Earth, just for solar panels. And here's the kicker. Solar panels are not a store of value. They are a consumption engine. When silver goes into a coin, it stays silver. It sits in a vault. It can come back to the market if the price gets high enough. But when silver goes into a solar panel paste, it is spread so thin microns thick that it is economically unrecoverable. It stays on that roof for 25 years and then ends up in a landfill. That silver is gone, deleted from the ledger of humanity. We are taking a precious monetary metal and vaporizing it into cheap energy infrastructure. We are burning the furniture to heat the house. And on Friday, while you were selling your stack because of a paper crash, the solar manufacturers were on the phone with refiners locking in supply for the next 6 months. They don't care if the price is 78 or 178. If they don't get the silver, the factory stops. The assembly line halts. The government contracts get canceled. They will pay any price. 3. The silicon hunger AI and electrification. But solar is just the appetizer. The main course is the electrification of everything. We are in the middle of the AI infrastructure build-out. You see the headlines about NVIDIA chips and massive data centers. What you don't see is the physical wiring that connects it all. High-performance computing generates massive heat and requires perfect conductivity. Copper is good. Gold is too expensive. Silver is the best conductor of electricity and heat known to man. It is non-negotiable in high-end contacts, in 5G relay stations, in the hundreds of millions of sensors being deployed for the Internet of Things. Electric vehicles. An internal combustion engine car uses about 15 to 20 grams of silver. An EV? It uses up to 50 grams. Some high-end models use close to an ounce. Every time a government mandates more EVs, they are mandating a short squeeze on silver. And let's look at the smart home revolution. Every smart switch, every relay, every circuit breaker, it's all silver contacts. This demand is invisible to the average investor. You don't see it because it's hidden inside plastic casings. But the refiners see it. The industrial demand for silver is perfectly inelastic. That is a fancy economic term that means price doesn't matter. If Apple needs a tiny speck of silver for the iPhone 18, and the price of silver goes from $30 to $300, do you know how much that increases the cost of the iPhone? About 20 cents. Apple doesn't care. Tesla doesn't care. Samsung doesn't care. They will pay whatever the ask is, but they cannot tolerate a shortage. So when they see the COMEX inventories draining, when they see bank failures, do they sell? No. They hoard. They are building strategic stockpiles of industrial silver because they know the just-in-time supply chain is dead. 4. The kinetic consumption, the war machine. Now, we must address the darkest driver of demand, the one nobody likes to talk about on CNBC. War is bullish for silver. We just discussed the troops moving to Iran. We discussed the carrier strike groups. Modern warfare is not about bullets and bayonets anymore. It is about guidance systems, radar, avionics, satellites, and smart munitions. A Tomahawk cruise missile contains roughly 15 kilos of silver. A Mark 48 torpedo? Hundreds of ounces in the silver-zinc batteries. Why silver-zinc? Because they have the highest power-to-weight ratio and they are shelf-stable for decades. You can leave a torpedo in a submarine for 20 years, and when you fire it, it works. Lithium can't do that. Only silver can. Every time a missile is fired in the Middle East, every time a drone is shot down in Eastern Europe, that silver is gone. It explodes. It is vaporized into dust and scattered over the desert or the ocean. It is never coming back to the market. This is strategic depletion. The U.S. Department of Defense used to have a strategic stockpile of silver. Billions of ounces. Do you know when they sold the last of it? 2002. Today, the U.S. military has zero strategic silver reserves. They are buying on the open market, just like you, just like Samsung, just like the solar companies. So, when the geopolitical temperature rises, the Defense Logistics Agency starts making phone calls. They have priority ratings. They can seize inventory from refiners under the Defense Production Act. If we enter a true kinetic conflict in 2026, the civilian silver market effectively ceases to exist. It all goes to the war machine. And on Friday, with the war drums beating, do you think the generals were selling silver? No. They were realizing they don't have enough. 5. The supply cliff mining reality. Now, look at the other side of the equation. Supply. But John, the bears say, if the price goes up, won't the miners just dig more? No, they can't. This is the geological reality of 2026. The easy silver is gone. We dug it all up in the 19th and 20th centuries. We are now mining lower and lower grades. We are crushing tons of rock to get a few grams of metal. And look at where the silver is. Mexico, Peru, Chile. Mexico is the Saudi Arabia of silver. But look at the political situation there. Nationalization threats, labor strikes, cartel violence controlling access to remote mine sites. Production in Mexico has been flat to declining for 3 years. Peru is facing constant social unrest, blocking roads to major mines. You cannot just turn on a silver mine. It takes 10 years from discovery to first pour. 10 years of permitting, environmental impact studies, capital raising, and construction. Even if silver went to $200 an ounce tomorrow, global mine supply would not increase significantly before 2035. Most silver, 70% of it, comes as a byproduct of mining, lead, zinc, and copper. That means the silver supply is dictated by the demand for base metals. If we enter a global recession and demand for lead and zinc drops, base metal mines close, and guess what happens? Silver supply drops too. We are in a perverse situation where a recession could actually tighten the silver market supply even further. 6. The disconnect and the snapback. So, let's put the puzzle together for Part D. On one side, we have the paper market, the COMEX, a casino where banks trade digital promises of silver that doesn't exist, using 500-to-1 leverage, triggering crashes to manage their own book and fleece the retail trader. That is what you saw on Friday, a paper avalanche. On the other side, we have the physical reality. Solar panels consuming 30% of supply and vaporizing it, EVs and AI demanding more conductivity every year. The war machine burning silver in every missile launch. A geological supply cliff that cannot be fixed with money. Strategic rivals like China and India draining the vaults and forcing a 43% premium. The rubber band is stretched to the breaking point. On Friday, the paper market traded 1.98 billion ounces, more than double the annual production of the planet. It was a lie. A massive, systemic lie shouted through a megaphone of high-frequency trading algorithms. Meanwhile, the physical market is silent, tight, and disappearing. When the paper system breaks and with bank failures and margin hikes, we are watching it fracture in real time. The price will not drift higher. It will gap. It will go no offer. Imagine waking up on a Monday morning, logging into your brokerage, and seeing the price of silver is bid. $150 ask, none. That is what a failed market looks like. That is what happened in the nickel market a few years ago. The exchange simply closed. When you hold physical metal, you don't have counterparty risk. You don't care if the COMEX closes. You don't care if the bank fails. You hold the asset that the solar manufacturer, the missile maker, and the AI engineer desperately needs. The paper price crashed to flush you out. But the physical metal is being vacuumed up by entities that know exactly what is coming. They are buying the blood. They are buying your panic. The question is not why did the price drop. The question is, why are they trying so hard to convince me it's worthless, exactly when they need it the most? So, here we stand. The smoke is clearing on a $15 trillion crime scene. We have the fingerprints. JP Morgan closing 633 short contracts at the exact bottom. We have the motive, a liquidity crunch triggered by the first bank failure of the year. And we have the weapon, a paper market dump of 1.98 billion ounces to cover the tracks. But the past is written. You care about Monday. You care about what happens when the opening bell rings in Tokyo, in London, and in New York. We are looking at two distinct timelines for the next 24 hours. You need to identify which one we are in instantly. Scenario A, the bear trap, the violent snapback. In this scenario, the liquidation is over. The weak hands have been flushed. JP Morgan has reset their book. The physical deficit in Shanghai, that 43% premium, acts like a magnet. Watch the Shanghai Open on Sunday night. If silver gaps up in China while the West is sleeping, the paper shorts are trapped. They will have to cover into a vacuum. We could see a violent move higher, erasing the Friday crash in a single session. This is the V-shaped recovery. If you sold on Friday, you will be left behind. Scenario B, the liquidity black hole, contagion. This is the darker timeline. The failure of Metropolitan Capital Bank is not isolated. The margin calls in crypto this weekend are just the aftershocks. If Bitcoin breaks below 74,600, the Michael Saylor break-even line panic will spread to the equity markets. In this scenario, cash is king. Hedge funds will sell everything